Good morning, ladies and gentlemen. Well, we're still firmly in risk off, probably have an alleviation of the risk off next week as we have three central bank meetings, three majors, Bank of England, FOMC, BOJ, and they're all expected to do nothing. The reasons why they're going to do nothing is precisely because they don't have the data to do anything. So let's have a look at what the market is saying, what it did last week, and why it's likely to do not very much next week. Last week I told you that the real rates are likely to stay higher for longer now that Europe is trying to reflate. It's very, very unlikely that unless we go into a full-blown recession, or certainly much more of a growth slowdown than the data is suggesting at the moment, that real rates can come down. We had CPI and PPI last week, which basically show you that PCE in the US is somewhere around 0.3. Now, could it be 2.7? Yes. Could it be 3.1? Yes. But that still gives you a PCE which on an annualized basis is well over 3%. While we have that kind of data coming through on inflation, the only thing that can move nominal rates and therefore further along real rates is a real slowdown in the data showing much slower growth and therefore the prospect of lower inflation ahead. It's very unlikely that we're going to get that in next week, and therefore I expect real rates to remain around the 2% area or even start drifting slightly higher. You saw last week how you had every opportunity in bonds to do better, both in the US especially, but in other countries as well, as the stock market cratered for a bit, and they didn't take it. At the end of the week, they could do absolutely no better than the close of the previous week, and that is precisely because the market fears that there will be more and more funding pressure worldwide. So if more and more countries run deficits, even if the US reduces theirs, all that does is really change the level of the spread between them rather than the overall level of real rates. The overall level of real rates is likely to remain high. And the bond market did absolutely nothing last week. As I said, it tried to do better with the decline in stocks. It couldn't hold it. And it's basically found an equilibrium, expecting the Fed to cut sometime in June. Now, the data is going to have to collaborate with that. Otherwise, we're definitely stuck. I think that we've seen the low in 2s. And I think we've seen the low in 5s. Very, very difficult to see them doing substantially better without data. And until that happens, you just can't trade them. The only data that's for the real economy that's we get next week is retail sales. Now, could retail sales show the first signs of significant slowdown? Yes, they could. But unless we see that, we are just going nowhere. The auctions were very well received, which is not surprising given what the stock market was doing last week. But even the 30s and the 10s couldn't really do any better. So let's have a look at the 10s. What happened? Nothing. 1, 2, 3, 4, 5, we basically closed exactly where we closed the week earlier, and even 1 basis point worse. So what I'm telling you about real rates, I think, sticks. The yield curve is not going to be able to move very much, simply because we are already discounting so much by the Fed. 2s10s really didn't move, 5s30s didn't move. Nothing in the bond market moved, and the reason is one and the same. We need data to show a substantial slowdown to be able to make any progress. And I guess the progress we will make is one of continuous steepening if we get the weak data. Unless we get the weak data, we're basically stuck in a very narrow range throughout the yield curve and in all the tenors in the US. It's just going nowhere without the data. In Germany, we got confirmation that a deal is done, and all that does is really steepen the curve. Where are we in terms of the Schatz? Nowhere. We are not going higher simply because they are cutting rates, and still the ECB will probably cut rates once more. But if you have a look at, for example, 2s10s, you can see what's going on. It's a continuous steepening. And where can it go to? Well, I guess that we are almost done in the steepening. This kind of area down to -88 is not going to get broken in a hurry. So that kind of area, another, 10 basis point max, and that gives us all we're going to get for the time being, which tells you also that the Bund is really not going to do much worse for the time being. And let's concentrate on the Bund. It's still stuck around these levels of the major resistance around 290. And let's change that to the monthly, because you really need to have a look at where we are. We are right up against the Bollinger Bands on the monthlies, which tells me that we're going to stick around here for a bit, and then next month try it again, and the month after probably break and start going up towards 265. This is going to be a process which is going to take a long time. It's not going to take 1 month, it's not going to take 2 months, but you can see what I'm saying. Every time it dips, it's a buy in terms of yields, and a sell in terms of futures. I would love to see it back around the 270 area. That would be a wonderful place to start doing put spreads in the futures for a significant move over the course of 3 to 6 months to the upside. I am absolutely convinced that either the spread of bunds against the US really comes in, or the bunds by themselves do substantially worse. That is going to be the big play over the course of the next months. You can see in the 2s30s in Germany how we're getting very overextended, and if we touch 113 negative, we should have room for a bounce of at least 20-30 basis points, and that gives me hope that if we are patient, we will see much better levels to sell the bunds at. As I showed you, around that 270 area, I think that that is quite possible, and we just need to be patient and we'll get a very good entry. So no rush. The crosses between the US and Germany look completely different at what point on the curve you look at. You can see this is 2s, and they are basically coming back into where they were when the announcement from Germany was made. But if you look at 10s, it's a completely different picture. That's because the funding is going to be done at the long end. So just because 2s are going to remain stable does not mean that 10s will. I would have thought that when 2s are back to around this kind of level, they're 193 to 195, and they've closed the gap, that is when the bunds will have done all they're going to do on the correcting side, and hopefully they're going to be somewhere around here, somewhere around 160, and that will be the opportunity to look for them to go back down. I would have thought that sometime, in the next 2, 3, 4 months, whatever it is, and I showed you the monthly chart, that it's going to take a long time. We're going to go and trade around this 105 area. So the opportunity will come, but you just have to be very, very patient with the Bund and not rush it. And as the German-US spread stabilized last week, guess what happened to the dollar, i.e. nothing. This chart too, just like that spread chart of US against Germany, shows the possibility that we come back slump. And this kind of level, just short of 105, 104.80-ish, is going to be a great level to look for a lower DXY. I have no doubt that over time we trade down to 102, this kind of level here, but you can see where the Bollinger Bands are, and we need to give them time to widen. So in the meantime, it's a 105 or just short of, and we probably saw the lows last week for the next 2 or 3 weeks. Every chart tells you that you have to give it time, but the direction of travel for the dollar from now on is changed. It's changed because the differentials are changing, because real rates are going to be higher in the euro area, and hopefully as we get weaker data in the US, I'm not saying recession, far from it, I'm just saying that it's not going to be 2.5% real growth. It's going to be in the ones, maybe even below 1.5%, 1.1, 1.2 real growth, nothing wrong with that. And that is going to enable the next leg down. But it's going to take a while. Every chart is saying that it's going to take a while. In terms of Euro USD, you're looking at this kind of area between 107.70 and 107.10, 20. That is going to be the ideal level to start looking for the upside. It's going to take a while here as well. You can see where the weekly Bollinger Bands are. You really need this kind of move down to 107, 107.10, or even this kind of level, 106.70, to start looking to buy the euro again. Well, gold finally got to 3,000 and backed off a few dollars. It's outside the Bollinger Bands. It's very, very overbought on every time frame. And the one I keep on looking at is GLD over GSG. We are in an uptrend, obviously, and I caught this one beautifully, but I'm getting pretty worried that there's going to be an accident in gold over GSG. These kinds of moves are just unsustainable. And could gold really rip higher? Yes, it could, but I think it's so unlikely that over time we just say that gold does so much better than commodities. It just seems unlikely to me that we, if let's go for a monthly chart, gold is now 12 times the price that it was in terms of commodities, or let's call it 10. It just seems unlikely to me that we can maintain this pace of ascent of gold relative to commodities. So I still prefer commodities at these levels. I mean, still, I haven't done anything, but I'm preparing to sell gold for commodities and also for tip, because these kinds of moves are just, to me, unsustainable, and at some stage they come back. I think that at these levels, it really starts becoming ridiculous to want to own gold over something that gives you a real return of 2% over inflation. Unless we think that inflation is really going to be a major problem going forward, this has to be some kind of a warning here on the monthly charts in gold over TIP and also gold over GSG. The GSG chart per se is telling you nothing at all, but I still think that if it dumps over the course of the next week or so to this kind of level, 21.25, 21.10, you are really supposed to buy it. It is unsustainable to have this kind of this contract in a range for such a long time. This is going to be, 2+ years that it's in a 10% range. That just doesn't make any sense, unless inflation is collapsing. It just, I cannot explain it. In a 10% range for commodities for 2-3 years is a ridiculous time period, especially if we are having inflation running at 3% per year. At some stage, commodity manufacturers have to start hiking prices, and that to me means that GSG is going to be doing better. I would certainly prefer it. I certainly prefer it to gold, simply because I think gold has done the move and GSG needs to follow it at some stage. Well, I was wrong last week. We did dump again in the US, and I think the pattern is now clear. There is a very clear sell US, buy everything else kind of mentality going on at the moment, which I think is the opposite of what is happening in the bonds, and that would make sense. So it's a buy US bonds, sell everything else, and it's a sell US equity and buy every other equity, foreign equity. And that makes sense if people believe that the US is going into a slowdown. So you buy the bonds that are going to slow where the economy is slowing, and you sell the equities. That makes perfect sense. So what we are having here is a rotation, a dumping of US, which probably is, I hope, over for the next week. I've got quite good support here at 54.87, as I told you whenever that was on Thursday, that the risk reward down here was not great. And what did we do? We bounced, and we are at this 56.68 area, which is such an important kind of swing level. I think we'll probably spend the whole week going up and down around it and basically stopping everyone out every which way. Don't exclude closing this gap up to 57.69, but that's probably all she wrote. I really can't see it higher than that because the Fed is going to do nothing, and still the same pressure of sell US and buy every other asset is going to continue. And that you can see in the NQ as well. There's, where do we close? We closed last Friday here 20,200, and we just dumped, but we are holding certain levels. So I think the NQ could possibly lead us a little bit better, but it's not going to be a huge amount. It's still one of those that every time the markets rally, you overwrite calls. And that is really what volatility coming down on Friday, and that's a very good point that I'd like to tell you about. VIX came down quite hard on Friday, as you can see here. And the reason for that, I believe that it's simply because people are overwriting the market with calls. The people who don't want to sell, they're selling calls. And we got to close to the 30 level, which is very important, and now we close below 2280. And I think that we could easily come down to this kind of area, sort of the mid 18s, but that's going to be it for the time being. So don't get enamored with long positions, but every time the market rallies, I think it's a great opportunity in the US to overwrite with calls. And I think that that is why the volatility came down so hard over the course of the week, because even as the markets were doing better, even though the markets were doing worse, i.e. the US was getting sold, people were at every opportunity selling calls, out of the money calls against their current positions, which basically means that they believe that for the next several weeks, the US market is dead money. And if we look at what the foreign markets did, this is Nikkei. It closed up on the week, or basically it closed unchanged on the week, however you look at it. And let's have a look at EEM. As I told you on Friday, it closed up on the week. And if we look at stocks, they went down the least on the week, right? We had a very small down move on the week. So I think people will continue doing what works, and that is buying the countries which are reflating. That's Europe, that is Japan, that is China, and therefore EEM, and they will continue buying those and selling calls against their holdings in the US, because the US is unlikely to do much better. And I think that is the narrative for now on. Do I think EM is going to moon right now? No, I don't. We definitely need to see a couple of weekly closes above 45.04 to start thinking that the EM can start moving hard up. I don't think that's likely for the time being. I think it's more likely to stay in a range, and therefore, I like the rotation into EM, but I don't think it's going to lead to much higher prices. For those of you who want to monitor the health of the US economy, I don't think that this stage there's a better barometer than JPM. Let's have a look at this 225.5 level. You can see how long we spent trying to break it. Basically the best part of several months, a quarter. And if we enlarge this chart, we can actually see what it's doing. It's basically come back to the 200-day moving average, and on Friday it bounced off it. You'll remember my system that buys the 200-day moving average. Where should it bounce up to? Well, it should bounce up to at least this kind of level, which is 239, 240, close the gap to Friday, I would have thought. And that gives you really the probabilities of what the market is going to do over the course of the next few days. The Fed is going to do nothing. It's probably not going to change any of the dot plots, and if that happens, it's natural for the market to do that, to retrace that, and then we see. So watch JPM, watch that 225.5 level. If we start closing below it, there's something bad going on. And it'll be your first indicator, and JPM is a great indicator of the health of the real US economy, not the rubbish that sort of individual stocks can show you at times because they get overbought, they get this, they get that. JPM is as good as an indicator as you're likely to find. This one is Berkshire Hathaway, and I'm showing you two of my largest holdings simply because I cannot put this chart of Berkshire making new all-time highs or being as close to all-time highs as makes no difference in the context of a recession in the US. That just doesn't make any sense. If anyone is going to feel a recession, yes, it's going to be Berkshire as well. They might have a huge cash pile, but so what? It wouldn't be at all-time highs because they would certainly feel the recession with all their industrial businesses. So that tells me that it's a slowdown. It's nowhere near a recession. And when people start talking recession, you just have to say rubbish for the time being, unless this indicator changes. I just can't see how what I've shown you for JPM and what I'm showing you for Berkshire says that we are anywhere close to pricing in recession. That's just not going to happen, and that's why I believe that the bonds are more likely to remain in this upper level of range with real rates remaining high, because real rates would not remain high if we were pricing in recession, and we certainly would have much lower real rates. And I don't think that that is realistic while the indicators from the stock market from these individual stocks say that we are nowhere close to a recession. I think the message from this week is patience. We're going to see much better levels eventually to do something in the bonds, and the yield curves are basically likely to do very little now. I think the German curve is getting close to being exhausted in terms of steepening, and really having minimal positions for the next 1 or 2 weeks is probably the way to go, because whatever you do, you're likely to see better levels to do it at. So let's be patient. I think, again, the US market probably is the weakest of all of them, or certainly doesn't do better than the others in terms of equities. It seems obvious that the growth slowdown is being priced in the US much more than anywhere else, but it's a slowdown. It's nowhere near a recession, and I think that you're supposed to buy extremes of bearishness. So I'm certainly not a big seller of the US, but I recognize that for the time being, the market needs probably to sell some more. So we are in a confined range, and people will sell calls, and that will provide the market with the ammo it needs to probably go a little bit lower and a little bit higher. So it's a range, it's a tight range in the SPX. I would have thought that any time you get anywhere near this level, it's a big buy. 56.68 will act as a swing, but I can't really see it above 57.62. That, I think, is about as good as it gets for the time being. I prefer NDX to SPX. I don't think that the tech stocks are going to be as affected by the slowdown, and they have an international worldwide market, so to me they are fine. Thank you very much indeed, and tweet you on Monday.